fact, as everybody who invests in Bitcoin will tell you, I didn't get in early enough and I don't have enough. And it piqued my interest because I'm open-minded, right? And I thought, I've got to start looking into this, because there's lots of ways to invest your money, you know, property, ISAs, stocks, whatever it might be, right? But what I wondered was whether this could complement the other investments that I had. I decided to start reading about it. And he said to me, Vicky, read a book called The Bitcoin Standard. And actually, I'd really recommend that book to anybody. As long as I wasn't overexposed, maybe it wasn't so much of a risk to have Bitcoin. Maybe it was more of a risk to not have Bitcoin in case it actually did. Right? One of the important roles of an advisor is you actually stop your clients making silly mistakes. You're trying to make sure that along the journey, throughout people's lives, they're always going to be okay financially. I like the characteristics of Bitcoin. But actually, guys, you've now got to start to educate yourself on this really important topic. There's a whole learning process. I'm a strong believer that you've got to really understand something to be able to discuss it. And I think that that's the journey that advisors should go on, whatever kind of their views are at the moment, like just go on a little education journey.
Hi, Vicky. Welcome to the Bitcoin IFA podcast.
Morning, Dan. How you doing?
I'm very well today. How are you?
Good. I'm really well, thank you. Thank you for having me on.
Oh, an absolute pleasure. Always a pleasure to get someone in the financial advice world and a fellow Bitcoiner.
Yes. You're giving away all my secrets.
So talk us through you now work for, or you're the co-founder, owner, CEO of MELO.
Yes.
But you were an IFA in a previous life. So talk us through your IFA journey.
So I started as an IFA when I was 23. So gosh, around 18, 19 years ago now. And I did that for quite a while. I progressed to being one of the owners and directors of a financial planning firm based over in York. I also sat on the board for a group of financial planning businesses because ultimately we were owned by a holding company. And then at the end of 2018, we were sold, which came as quite a shock because I'm not of the typical sort of age demographic of somebody who sells their business. But it was a decision that was made ultimately by the shareholders because we wanted to, I suppose, move the business forwards with the support of another firm in tow. However, the reality of the situation post-sale was very, very different to what had been discussed on the run-up to sale. And I just couldn't work with the buyer, Dan. It was awful. I've never seen the soul get ripped out of a business quite so quickly. But I love the profession. I loved being an advisor, but I also really loved the profession. So it made me step back and sort of reflect and think, why did our business sale go so wrong? And why are so many business sales going wrong? Like, what's going on with this sort of cultural alignment piece? And I recognized that there was a gap in the market for practitioner-led support for financial planners who were looking to exit. So somebody who truly understood what it meant to run a financial planning firm so that we could represent those businesses really effectively. But most importantly, our clients are contracted to us, so it gave us whole of market access, which meant that we could really get that cultural alignment piece right, rather than sellers just going into the same sort of named consolidators. So that was the birth of my M&A business around 6.5 years ago. Fast forward to now, we're called MELO, and we support business owners not just on their journey to exit, but we also work with firms that are looking to grow too. So it's brilliant. We're working with some of the most ambitious businesses in the UK with huge targets, great, exciting BHAGs, and we're rolling our sleeves up and getting right stuck in with these businesses. So. And I've got a team that's amazing as well, Dan. Like, I pinch myself. I'm like, oh, my team is so good.
Well, that always helps, definitely. And that's obviously a reflection of you, right? You're building a business in your own reflection, and you're not going to hire bad people. There is actually a lot of consolidation in the business, right? So what are some of the challenges there, or what are the typical challenges that you're facing when making sure there is that cultural alignment and that you're not just selling an ambitious business that maybe, let's say, client-centric, client first, and then selling it to, large consolidators, private equity maybe, who are, just purely focused on the bottom line?
I mean, from my perspective, I'm kind of completely buyer agnostic, and I see the good and bad in what I class as sort of all flavors of acquirers. So if you think of like kind of the options that are out there for sellers, it's a bit like a tapestry of different flavors of acquirers, different types of acquirers. And then even within those different types of acquirers, they have their own ambitions and their own propositions and their own business models, et cetera, et cetera. So the key to this is not coming in with any preconceived opinions about what is going to be right for that seller. I don't sit there and think private equity is bad, local businesses are good. I start from a position of let's understand you as a seller. Let's understand what is really important to you. So what are your red lines and what are your nice to haves? And let's, as importantly, understand why your clients really enjoy working with you. Why do your clients stay with you? And that's the cultural alignment piece, right? It's trying to make sure that when there is change, because there's always change, right? When a business gets sold, you've got to appreciate that you're going to have to fold into the buyer's model. So you've got to like the buyer's model, and you've got to look at that and say, is this going to work for my stakeholders, which are my clients and my staff? Are they going to be in a better position as a result of this sale? So that's the process there that we go through with sellers, kind of really understanding them, what their clients enjoy about working with them, and making sure that the buyer can kind of uphold that legacy. And then we introduce to a load of businesses like a funnel. We start with a good spread, and then gradually we work down from there, always looping back to the seller objectives at the start.
Well, that's amazing. So, yeah, starting agnostic is great. And then what challenges do you find that, like, is it often easy to align with cultural fit and making sure the stakeholders are looked after?
It's, I wouldn't say it's easy necessarily, but it's definitely possible. And I can say that because I've been doing this now for such a long time. Like I've had a lot of businesses that have not just sold, but they've gone all the way through the deferred consideration period. So they've had their monies out, they've fully exited themselves. So I know that the success rate amongst my sellers is vastly different to what you hear about in the press, and possibly the press might embellish certain statistics because it makes for good reading. But that makes sellers nervous because they come to me often with this uh, worry, fear that actually everything they built is going to be dismantled. And if you wrap the right team around you to support you at outset, then they'll make sure that that doesn't happen to you. So, I'm not here to say every single sale goes perfectly, but there are so many different acquirers out there and so many amazing business models out there that you can usually make a really nice introduction to a number of businesses and find the right outcome.
That's great. That's great. And so it sounds like headlines might give us some FUD, fear, uncertainty, and doubt.
Yes.
That's something that happens quite a lot in the Bitcoin world. This is a Bitcoin podcast.
Indeed.
So, a question I like to ask everyone is, everyone's against Bitcoin until they're for it. So,
Yeah.
talk us through your Bitcoin journey.
Well, as most people, in fact, as everybody who invests in Bitcoin will tell you, I didn't get in early enough and I don't have enough. I got into Bitcoin probably around 5 years ago, something like that. And it was my friend who got me into Bitcoin. Now, I'd known about it. I actually used to have a client when I was a financial advisor down in London, and I remember him telling me about it when I went to see him. And it was around about $2,000 a Bitcoin at that point. And it piqued my interest because I'm open-minded, right? But because I'm a financial advisor at heart, I have to understand things before I go forward. And I was busy and there was various sort of conflicting views coming out. And so, I made the decision at that point not to look at it any further. And then one of my very good friends got really into it, started reading all about it. You know, when he was coming round to our house, he was sort of telling us about it. And I thought, I've got to start looking into this, because there's lots of ways to invest your money, you know, property, ISAs, stocks, whatever it might be, right? But what I wondered was whether this could complement the other investments that I had. And actually, if he was right about what he was saying, as long as I wasn't overexposed, maybe it wasn't so much of a risk to have Bitcoin. Maybe it was more of a risk to not have Bitcoin in case it actually did, whew, right? So I decided to start reading about it. And he said to me, Vicky, read a book called The Bitcoin Standard. And actually, I'd really recommend that book to anybody. It was written, I don't know, maybe 15 years ago, I think, possibly, Dan. It's quite an old book now.
I think it was more like 16, 17. I actually, side note,
Right.
I know because I lived in Lebanon, and Saifedean Amos, the author, was a lecturer at the American University of Beirut, so AUB. It's quite a famous international university.
Okay.
And I'm actually friends with a chap who was in Saifedean's last cohort. So he was being taught economics by
Okay.
Saifedean. And Saifedean just announced one day towards the end of the year, I'm no longer being a lecturer. I've written this book. It seems to be going pretty well. So he stopped being a lecturer.
That's amazing. I love it when people know people. It's like, okay, this is cool. I'm getting closer. I'm getting closer to the people who really know. This is fun. So I read this book. What I really liked about the book was that it took you through the history of money. So it wasn't just, you know, this is Bitcoin, this is how it works. It's like helping the reader to understand how money itself has evolved, and that money is merely just a mechanism to transfer something from one person to another. Um, and I found that part of the book in itself really fascinating. And then from there, it's moving into, okay, well, now you really understand money and you understand how money has changed, or the transfer of value has changed over time. Here's now how Bitcoin could actually be the future of money. And so giving myself that grounding and that understanding of something, I was like, okay, I'm going to start to get into this now. And I've been buying Bitcoin ever since. I block out the noise, Dan. I don't. I try not to listen to the noise that surrounds it. I'm not a trader. I buy and hold. I haven't got time to trade. Um, and I my view is that you've got to have, I mean, you know, you've got to have the right risk profile to an extent, because it's very, very hard when you are in this space and there is so much news around it, to actually hold steady. And I love when you read sometimes about people who, you know, have maybe sold Bitcoin when it was at a much lower level. And people are saying, you know, well, if only they'd held on to it, it would now be worth X. I don't think there are many people who have consistently held on to it, because it's such a turbulent journey for people to go through. You've kind of got to, you got to have a bit of a tough stomach, if you know what I mean. And this is where, as with everything, you've got to not be overexposed. You know, it's about seeing it as part of your overall portfolio rather than the overall portfolio. Although, having said that, I do have friends who are Bitcoin like maximists, and it's like, you know, this is all we've got. So yeah.
There's a couple of things I want to touch on there. So I can speak from experience about being overexposed. I made an absolute mess of my first cycle, lost a lot of money. And if I'd have just held, I probably wouldn't need to work again. So I can certainly talk through that panic mindset when we get into the cycle lows and you think it's bottomed, and then FTX collapses, for example, and it drops 25%
Yes.
in a day, and you think, oh, this thing could go to zero, and I am overexposed. So
Yeah.
I can absolutely speak from experience there. It's tough to hold through that, and that's why, you know, in my workshops and when I speak to financial advisors, I think for most people, you're absolutely correct. It is a complementary asset that you probably want to be looking at 1 to 5%, depending on risk profile, etc. And there's, lots of stats and information that I go through in my workshops about, it's a complementary asset in terms of risk profile. It's a massive diversifier, has very low correlation to equities and bonds, and no one knows the future, right? No, anyone that tells you they know what's going to happen is either lying or naive.
Yeah.
But as financial advisors, we are professional risk managers for our clients. Everyone in their life is a risk manager, but we're professional risk managers for ourselves and our clients. And that's why we diversify. We don't just buy the Mag 7, we buy all the equities so that we can benefit from the Mag 7 plus all the rest. And that's how I try and frame it. It's the latest addition to the great companies of the world. It's the latest addition to evidence-based advice. If you've got any global equity exposure, you're probably exposed somewhere between 1 to 2% to each of the Mag 7. And this should just, it's not comparable to a tech stock. It's more comparable to digital gold. But in terms of exposure, I think that's, depending on risk profile, et cetera, I think that is a good starting point. Do you know Pete Dunworth?
I don't.
So he's the owner of the Bitcoin Advisor, which is a global custodian company, but he's also been a financial advisor for 20, 25 years. And he put 1 to 2% of his clients' portfolios into Bitcoin in 2016. It's gone 150x since then. His firm's revenues have gone 5 to 10x as a consequence.
Wow.
So, side note, as advisors, if you can find another vehicle where you can put 1 to 2% into a single asset that 5x's your firm's revenues over the next decade, do that because your clients and you win. But to my mind, Bitcoin's the only one, and he believes. So he gets 100% of his referrals now, or 100% of his new biz comes from referrals. People talking about what he's done to their portfolios on the golf course to each other, and it will, so it's just built this flywheel. He believes there's still 100x in front of us, and I think when he said that to me, it was in May, and I was like, I'm not sure, that seems punchy. But even the speed at which everything's moving in the last couple of months, and even just yesterday, Trump has said that he's now allowing the $9 trillion asset class, which is 401ks, which is US pensions. He's opening that up to gold, private equity, and Bitcoin, crypto. So yeah, I think you're absolutely right in terms of not being overexposed. That being said, actually, I was at Cheat Code, which is a Bitcoin conference in April, and I met a chap in his 70s who has completely moved to the Bitcoin standard. So he travels around the UK in his camper van, sold everything, put it all into Bitcoin. And then when he pays for stuff, the card he was using does an immediate transaction from Bitcoin into fiat so that he can pay in fiat.
Yeah, that's this. I know a couple of people who do the same, and people. I think. Do you think, Dan? People think they've missed the boat. Because I look at kind of where we are in the sort of overall Bitcoin journey, and I'm sure on like your webinars and through your training, you talk to people about the halving, which is obviously a very key part of the learning that financial advisors would need to do. But when you look at the halving that is going to happen over the next sort of 100 years or so, or maybe even longer, you might tell me, you realize we're still in setup phase, like the boat has not gone. It's not left the harbour.
So we're at about 3% global adoption. We haven't even left the early adopters phase in terms of the S-curve of technology adoption. We're nowhere near early majority yet. So it's about 3% global adoption, which is the equivalent of the internet in 1990,
Right.
online banking in 96, and social media in 2005.
It'll never take off.
Yeah. And yeah, you're absolutely right. I do think that some people see the price, as we're recording today, it's $120,000.
Yeah.
And it's, it's just around all-time high in Great British tea drinking pounds. We're at about £90,000. So I think people do see that and think they've missed the boat. It's buying a whole Bitcoin is beyond the grasp, beyond the realms of 99% of the planet now.
Yeah, yeah.
But obviously, I don't think they realize it's divisible by 100 million units called sats. So it's almost infinitely divisible. You can buy a pound of Bitcoin. I buy Bitcoin every day. I buy about a pound a day at the moment, because I've just set it up as a DCA. That will increase as we reduce. I buy the dips.
Yep,
Um,
yep.
and it's about 1,000, 1,200 sats a day. So, you can buy a very small amount. You can send microtransactions to each other. But I do think people see that, it's done this almighty journey over the last 16 years, which is why they then go further out on the risk curve and start going into the XRPs, unicorn fart dust, because they want dopamine inducing 100x's in 3 weeks rather than 100x's over the next decade.
It's interesting, right? You're sort of starting there to talk about other types of crypto, and I've never got into anything else because, again, it comes back to the knowledge that I need to have. And I don't see Bitcoin as falling into the melee of all of the rest of them at all. I like the characteristics of Bitcoin. And I just can't get my head around, nor do I have the time to understand which of these others are going to fly, which are going to flop. Are you similar?
I unfortunately had to go through my altcoin phase like everyone else.
Okay.
um, but I had a cleansing a couple of months ago actually. So I sold everything. I had loads, like small allocations to a bunch, and it was pure gambling. I hadn't also
Yeah.
done much research. It was just AI and tech and predominantly AI, and then some of the larger ones. And it was just like, where is also its attention? So like Doge is going to get attention. It doesn't really do anything,
Yeah. Yeah.
but it's going to get attention. So, but I had a cleansing. I sold out of all of them, and I put all of that into my ISA and bought SWC. So not promotion, not financial advice. Do your own research. But Smarter Web Company, who IPO'd in April, are replicating the strategy. I still strategy. They're
Okay.
just starting out on their journey. So I'm now I heard someone described buying Bitcoin treasury companies is now the gentlemanly way to altcoin.
Okay. I think I'm just going to stick to what I know, and then I'm going to regret it in a few years' time. But that's fine. Like, that's my overall crypto journey. That's cool.
But
But on the advisor's side, like, I think something you said earlier on was really important, right? Because advisors, do look at risk. Absolutely, they do. And they look at risk in two areas. They look at risk in regards to their clients and their clients' portfolios, because for the majority of financial planners, they are working with what I would deem as the mass affluent. Often we band around, the term high net worth and stuff like that. But my view is if somebody's got a pot of money and they're going to need to use that pot of money to live on later on, they fall more in the mass affluent crowd. And so you find financial advisors trying to either access or build portfolios that do tend to focus on protection on the downside. Yeah, we're not trying to grab all of the upside. We're not trying to shoot the lights out. We're trying to give people a steady journey, right? So that could be a concern for them regarding sort of introducing the Bitcoin from a client perspective. But then, of course, risk-wise, they're also looking at risk within their business because these are regulated businesses. We have a boss essentially in the FCA. And so it's just going to be really interesting for me to hear your views on those two risk elements, them trying to manage the portfolios from a risk perspective and trying to make sure that they don't sort of introduce something into their business that could cause them issues later on.
hey team, a very quick pause. If you're a financial advisor, wealth manager, or accountant, chances are your clients have already asked you about Bitcoin. And if they haven't, they soon will. Which is why I've created the Bitcoin IFA webinars. The webinars are designed to give you all of the information you need to confidently talk about Bitcoin with your clients. They're on demand, so you can watch them at a time that's suitable for you. They count as 90-minute structured CPD, and you'll get priority access to the Bitcoin IFA community. Head over to thebitcoinifa.com to book your webinar today. It takes less than 60 seconds. Again, that's thebitcoinifa.com to book. Now, back to the episode. Well, I think, you bring up a really good point there. So because we're only 16 years into this 150-year journey just to mine all of the Bitcoin, right?
Yeah.
So it's a 150-year experiment before all of the Bitcoins are mined. We're 16 years in, so people like to call Bitcoin a bubble. The characteristics of a bubble are very short time frame, pump, dump, crash to baseline or below, and that's it. It happens once. Bitcoin's in its fourth cycle. It's never crashed to baseline. It's always, it is volatile and it does crash, but it crashes back to the miner's floor price, right? So at the moment, the miner's floor price is about $75,000. So we would expect, based on historical data, that whatever we see over the next few months, again, based on historical data, we would expect the next few months to be explosive. Wherever we end up, we would expect it, based on historical data, to crash back down to about 70, 75, maybe 65, something like that. Not price targets, not predictions, right? Just that's the observable cycle. So, if it runs up to 300,000, 500,000, even if it just goes from 150,000, that's a 50% drawdown. 300,000 is what, like 75% drawdown. I'm trying to do the maths off the top of my head. That's incredibly volatile, and it's very difficult to manage clients who are especially in decumulation.
Yeah.
If their portfolio is going to be that volatile. So, Rick Edelman, who owns one of the largest firms in the US, has recently come out with quite punchy targets and said that low risk clients should have a 10% allocation, medium 25%, and adventurous clients should have a 40% allocation to Bitcoin. Now, those are wild targets. You may see exceptional returns, but you're also going to see, to date, Bitcoin has a very observable cycle, which is 3 years up, 1 year down. And the 1 year down is somewhere between 50 to 70% drawdown. So if you've got 40%, 50% of your portfolio, that could make planning very difficult. Also, cash flow modeling tools. I was dabbling with some for some of my B2C clients, and I was trying to input what I see as sort of more realistic data, which is, a 10% purchasing power is your hurdle rate. So I was putting inflation in at 10%, and then I was allocating, 10, 20, 50% to Bitcoin, showing different models. Bitcoin's currently doing about 50% ARR since 2020, including drawdowns. So, it tends to do like 3 years of 100% and then 1 year of 50 to 70% drawdown.
Yeah.
Averages out at about 50% ARR. Well, the cash flow modeling tools couldn't really keep up with that because it was just like tiny explosion at the end. So when they get to 90, multi-billionaire. So, there's challenges around the tools that they use as well. So hence why I think to really manage risk, they need to start small, 1 to 2%. This is exactly what Pete Dunworth did with his clients in 2016. He said a 1 to 2% allocation to Bitcoin. If this thing goes to zero, that's a bad day in the stock market. You won't notice it, right? You won't notice a 2% drawdown in the stock market day to day. So you won't notice a 2% allocation to Bitcoin that goes to zero. But the asymmetric upside, where it went 150x, you now notice that this now represents 50 to 70% of your portfolio. Your portfolio is 2 to 3x in 9 years. And we probably need to do some rebalancing, right? Which is also going to be that's another challenge for advisors. Hopefully it's a good challenge to have, which is, I've made you so much money.
Yeah.
We now need to rebalance some of this back into equities and bonds, especially if you're in decumulation. There's a website called nakamotoportfolio.com.
Yeah.
And I would highly recommend checking that out, because within that, what you can do is essentially backwards facing modeling. So you can go in, I show some of this in my workshops. I show the effect of a 1, 5, and 10% allocation to Bitcoin over the last 10 years, from 2015 to 2024, on a 60-40 portfolio.
Yeah.
With and without annual rebalancing. But what you can also do within that, and I've seen some stats on this, and I'm trying to remember them off the top of my head, but I think someone showed that if you put just 2% allocation to Bitcoin in 2020 and 98% in cash,
Mm-hmm.
that has returned 17% a year. So that's returned
Oh,
significantly more than just having it in the S&P 500. So there will be challenges, but those challenges I think can be overcome by, when you start seeing, if you get three years up, then you just rebalance. And if they're in decumulation, you don't rebalance back into equities and bonds. You just rebalance back into cash. You just say, look, we're going to take some of this profit off the board, keep you in cash. And we're still returning whatever it is, 10, 20, 30% a year. So
yeah.
and then obviously all of those challenges, I think, are identical between both the clients and the business, because especially if you're operating an AUM model with, where you earn a percentage of the assets, then the risk to your firm's earnings are replicated in the risk to your clients' portfolios. What are your
I
thoughts?
well, just to pick up on a couple of things there, I think more and more now businesses are focusing on what do our portfolios look like for clients that are in accumulation, and what do our portfolios look like for clients that are in decumulation. And this is a real area of focus from the FCA at the moment. They are looking into retirement solutions that financial planning firms are providing. And so I suppose thinking about what you were just saying there, like it doesn't necessarily have to form part of every portfolio. It could be something that sits in your central investment proposition for accumulators or for younger people. You can, I suppose, decide on house views on that sort of thing. But then, you could have quite often these businesses have separate portfolios that are more targeted on capital preservation and a smoother journey when it comes to decumulation for exactly the reason you just mentioned. The kicker is drawing down when things have gone down. So I think, it doesn't have to be an all or nothing. Like you said, it can be, something that they start with in some different way, shape, or form. I was thinking more though, Dan, like about the sort of regulatory side of things, because obviously one of the biggest concerns for financial planning firms is where is the where is the border between guidance and advice at the moment, because it's not a regulated asset, and that can make them nervous to potentially talk about it with people. I think that when you mentioned earlier on that you were surrounded by noise when it came to altcoins, and so you dived in to some of those altcoins. One of the biggest issues for financial planning firms is intergenerational planning. It's something that everybody is aware of. All acquirers are aware of the stickiness of assets. What is going to happen when mum, dad, grandma, or granddad pass away? And I think about the younger generation coming through, and they are absolutely surrounded by noise on this topic. They know so much about it. I'll speak to younger people who, sort of from when it was my generation, they didn't really have an interest in money. The younger generation actually do, but they have a real interest in this. Whether that's a good thing, whether that's a bad thing, is largely irrelevant. It's something they want to talk about. And I think that advisors, therefore, have to at least be building their knowledge to talk about this topic so that they're able to talk to consumers about what they want. That's what we have to remember as financial advisors, right? It's like we're there to offer advice. Of course we are. But we still rely on consumers like any other industry or profession. And we have to be thinking about what are consumers hearing? What are consumers wanting? How are consumers receiving and absorbing this information? And I think we have a duty, therefore, to at the very least be able to talk about these topics that might be important to some clients. So, where this is my long ramble in kind of wanting to ask you, when do you think the FCA are going to look to start to regulate this? So it almost becomes this is a conversation that we have to start having. And as we sit here today without that regulation, how could advisors still access this? And where do they stop talking about it, if you know what I mean? I think that's going to be part of the challenge for them.
Okay, so there's a few things you've touched on there.
Yeah.
So let's make sure we cover them. So where can advisors access Bitcoin, let's say? That's one. How can they talk to their clients about it within regulations? It's two. And then intergenerational planning and age profiles. That's three. Remind me of
Yes.
those as I go along.
I have my trusty pen and my trusty MELO notebook.
Okay, so firstly, where can clients access Bitcoin within current, where can clients get Bitcoin exposure for their clients within current FCA guidelines?
Yes.
There are a number of routes. There's 2 or 3 routes to my knowledge. I'm actually going to put a slight kibosh on this because that's my IP. So if people want that information, unfortunately, they are going to have to buy my webinar paper or come to a workshop.
I tried, guys. I tried.
Because that is really critical information. I've done all the research on that.
Yeah.
The information's out there. If someone wants to find it, they can find it. I just charge because I'm basically charging to save you time. So that's the first one. The second one was, how can clients talk about it now? So I actually had Chris Clark on my podcast recently. He invests 50% how he tells his clients to invest, and he invests 50% into Bitcoin. And so when he has client meetings, and if clients bring it up and say, well, how would you invest? How would you do this? He's very open and says, look, this is how I invest. I can't tell you to invest in Bitcoin. You can't recommend it. You can't advise on it, but you can adopt an educational or an educator mindset and just say, look, this might be something that you may want to look into, right? It might go to zero, or it might become something, right? So, and what he does is, in his office, he has copies of The Bitcoin Standard, The Price of Tomorrow by Jeff Booth.
Okay, I don't know.
And I forget the title, but if someone wants to find it, it will be really easy. You can find it on Amazon. It's something like Bitcoin for 5-year-olds, something like that. And it's essentially a sort of picture book, really easy to consume introduction to Bitcoin. So start there, right? Because it's, that will take you 10 minutes.
Yeah.
Also, if you're not subscribed, go and subscribe to our newsletter, because I give you 2 free downloads, which also within 10 minutes give you the basics on Bitcoin. So what you can say is, it might be something that you want to research yourself. Here are some resources, right? And you can also say, if there is something you invest in, I invest in this.
Yeah.
I can't tell you to invest in it. But that being said, you can currently get exposure to Bitcoin through certain products within current FCA guidelines. Now, we expect the FCA to lift the retail ban on Bitcoin and crypto ETNs. The rumors I'm hearing is September. So they obviously announced their proposal to do so on the 6th of June. They have opened a consultation, which I think as of today may have closed. I'm unsure. But my understanding from people who have a lot more experience of this with the FCA is that the FCA only really do that when they've already made up their mind. So it is likely to happen. We're hearing September. So as of the date of recording this, within about 8 weeks from now, we would expect that retail ban to be lifted. At that point, you can advise on Bitcoin. The routes to Bitcoin exposure at that point would actually probably remain the exact same as they are now for a while, because, as Chris said to me on the podcast, the first thing you're going to have to do is find a provider to give you the stochastic profiles, so that you can actually show that the allocations to Bitcoin. You're going to need to find platforms who will give you exposure to the ETNs. I'm not sure if there are any yet, but that will be led by client demand. There is one platform that you can use now that is FCA regulated, protected by the FSCS scheme, have a portfolio. I talk about that in my webinars and workshops. That will still remain the same at that point, right? So there are routes. You can talk about it as an educator, mentor mindset, a coach. You can be a coach mindset. You just can't recommend it or advise on it. And then the third one we discussed was intergenerational planning. So that's a really key thing that you've touched on there. So within the webinars and the workshops, I showed the demography of people that own Bitcoin within the UK. So over half of them are in the 35 to 54 age brackets. They are accumulators.
Okay. Yep. That's interesting.
So it's about 56% are in that age bracket. So they are the generations coming up behind your retirees, right? So if you have clients who are retirees, it is more than likely that their children and their grandchildren own Bitcoin, because over half of the Bitcoin owners are in that demographic. What's really interesting is on that same chart, it has the demographic of altcoin holders. They skew younger. So they are,
Right.
so I think about 50% of those are in the 18 to 34 bracket. So those are the guys that are chasing quick wins because, they're broke, right? So they don't want something that will make them rich in 10 to 20 years. They want something that makes them rich today because they've got their eyes on, buying a house, having children. And I also think Bitcoin itself lends itself to being a bit more mature anyway versus altcoins. Like, it isn't, apart from the next sort of 3 months that we're facing now in terms of the historical cycle. So the next 3 months, we would expect to see about 30 to 50% of all the gains of the cycle based on previous cycles, right? So we've already gone about 8x since the lows in 2023. And we could, based on previous cycles, expect another 2 to 4x from here, right? So apart from these 3 months, which are, dopamine inducing, mania, etc., Bitcoin is relatively a slow grind. It just, slowly grinds up for 3 years, drops for 1 year, slowly grinds up for 3 years. Altcoins, on the other hand, go bananas all the time, right? So, as soon as there is liquidity injected into the system, we've had sort of 2 or 3 alt seasons during this cycle already. So during the run up to the all-time high before the halving, first time that's ever happened, we saw a massive alt season. We saw a massive alt season last November, December. And we're starting to see the beginnings of an alt season now, although there has been a bit of a decoupling. So Bitcoin's performance this cycle has massively outperformed the altcoins. And I think that sort of dopamine chasing energy and mania lends itself to being a bit younger. So hence why I think I had a cleansing to, drag myself into maturity. Does that answer your questions?
It does, right? Because one of the things, like, I've heard a lot of advisors say, and I used to say it as well, was one of the important roles of an advisor is you actually stop your clients making silly mistakes. So if we were to roll up to, like, the most recent budget, there was a whole load of noise out there about, what was going to happen to pensions, for example. And the result of that, like, I remember listening to this panel discussion, and there was a guy on there, I think he was from Aviva or one of the sort of very large companies that offer pensions, and they have a load of direct clients that don't have access to financial advisors. And he spoke about how many withdrawals they processed in comparison to the norm on the run up to the budget, because these clients didn't have access, these investors, they didn't have access to advisors saying to them, block out the noise, we've been here before, you've got to keep going, we know what the plan is, right? And they made, in a lot of cases, some really catastrophic mistakes at that point that they can't unravel. And I see that as kind of similar here. It's like, if this younger generation, so you've just spoken about the age demographics, right? And as you go down, all of a sudden you've got grandkids of these typical financial planner investors. You've got the grandkids who are potentially making some really poor decisions because they're trying to grab hold of these old coins that aren't working, or that could boom or could bust and could end up costing them a lot of money. But if this is where I think it's so important that advisors talk to them or have the ability to talk to them, because if they feel heard, they're not going to go and seek advice, guidance, whatever you want to call it, on X or on some other platform. They're going to feel like, do you know what, actually, there's a guy or a lady here that's advising us, and they're at least having a conversation with me. And so maybe if I am interested in that sort of thing, I'm going to look at things that have stood the test of time a little bit more, and I'm going to make better decisions as a result of that. So I just think this is this ability to talk to clients and future clients. I don't think it can be underestimated, just how important it is, like, not just to future-proof the business, but to also continue to do what we want to do as advisors, which is help people to stop making the wrong decisions.
Yeah, I completely agree. And I like to think of financial plans in terms of vaults and engines. So your vault is where you protect your purchasing power, right? So that's, if you listen to the trap guys and, evidence-based advice, the great companies of the world, well, the great companies of the world typically returns about 10 to 12% a year.
Yeah.
Well, when you factor in inflation plus debasement, right? So we're always given an inflation, we've got to beat 2% inflation. Well, side note, inflation hasn't been 2% for half a decade at this point.
Yeah.
But we also have to factor in currency debasement. And when you factor in both of those, it comes out at about 12%. So guess what? Like the real hurdle rate is about 12% because all of that debasement and inflation finds its way into the stock market.
Right.
So your vault is the great companies of the world, and that's where you protect your purchasing power. Then you have your engine, which is where you're going to try, or the trap guys would call this your playpen. I call it your engine. That's where you've got to try and beat the 12% hurdle rate after fees, after taxes, to actually drive wealth within your portfolio, not just protect your purchasing power. So that's obviously client centric. It depends on each client. If you're in decumulation, your engine is probably 5%. If you're in accumulation, your engine might be 25%, right? But within the engine, if you're going to go into something like Bitcoin, or crypto, let's say, then you do the exact same thing. So if you're doing the Pareto effect, which is 80-20, so vault to engine, well, then within your engine, if you're going to go into crypto, purely crypto, let's say, you're not also looking at gold and private equity and VCTs and all that jazz, well, then you do the exact same exercise, which is the Pareto effect. So we're going to do 80% into Bitcoin, 20% into other crypto. And so the way I liken other cryptos, alts, is a bit like a casino. Have fun, right? Make it very small, have fun, assume the house always wins and that it's going to zero. If it doesn't, great. But, make it a tiny percentage that you're going out, it's like a casino, you're going out for one night, you're going to spend 500 quid, assume that it's all going, but you've had a great time, right? But if you walk away up, great, right? Whereas with Bitcoin, based on the characteristics of Bitcoin, the 16-year trend at this point, the 16-year experiment, then you can expect it to go up in future based on historical data. It's also, side note, a 0% allocation to Bitcoin at this point is essentially gambling that a 16-year trend is going to reverse. So Bitcoin has outperformed equities and bonds for 16 years in a row. And so if you're saying we're not going anywhere near it, you're essentially saying I expect this 16-year trend to reverse any day now.
It all comes down to capacity for loss, doesn't it? We still unfortunately see a lot of companies and a lot of advice firms not quite getting the capacity for loss piece right. It's an education in itself, is understanding that. But, ultimately that's what it comes down to. I remember when I was an advisor, I was building a new website for our business and I went to see this guy that was building it for us. And he says to me, Vicky, explain to me like what you do, right? Because he was a web designer. He worked across all sectors. So he didn't have a particular sort of knowledge of our space. And I went on and I told him like everything I knew about pensions and all of this like amazing, like I'm just going to talk to you about all my technical knowledge. And he sat there and, well, first of all, he was probably bored by the time I finished. And then secondly, he goes, right, so you just make sure people are all right. I'm like, yeah. And he's like, you've got to recognize, Vicky, like how, what your role is. He said, and when I try to distill it down into its really simplest form, right, you're trying to make sure that along the journey, throughout people's lives, they're always going to be okay financially. And I thought that's absolutely it. And that is capacity for loss in a nutshell, right? This isn't about overexposing clients. This isn't about putting people into something that they're not comfortable with. This isn't about you as advisors going forward with something that you don't understand. There's a whole learning process. I'm a strong believer that you've got to really understand something to be able to discuss it. And I think that that's the journey that advisors should go on, whatever kind of their views are at the moment. Like just go on a little education journey. because it does come back to risk and it comes back to capacity for loss. And, and as well, as we said, consumer demands and what they're hearing and what they're talking about. And, there's ways to manage all these things, within what you do. I'm keen to know, Dan, right though, because you've been doing this a little while now. And I found you because Alan Smith, so one of the trap guys, had put a post out on LinkedIn. And I think his guys were doing like a training session with you or something like that. You'd gone in to deliver this CPD. And I thought, right, this is interesting. And started to follow you since then. But how have you found it getting into the advice space with a topic like this? And what sort of firms are engaging with you?
Great questions. This is weird. I feel like I'm now on your podcast. Great, great questions.
I'm nosy. I love it.
So there's two questions there, right? So how have I found it and which firms? So
yeah,
it is challenging. I feel like I've made some noise. Alan has been super helpful. I've said to you before that, as a mentor, I couldn't be luckier, and I'm super ambitious and obviously want this to work, but I often get the feeling that he wants this to work for me more than I do, and I couldn't be more grateful.
That's really cute.
So it's a lot of it is down to him and his help. So I've, through Alan, made a bit of a splash, had some initial pushback, right? So I've had there have been some comments on LinkedIn and Twitter that have touched me in a way that I thought wouldn't. But overall, what I'm finding is there is a small cohort of advisors that are, Bitcoin maxis. Then there's, let's say that's like 5%. Then there's like 80% who are just completely apathetic. This is too new, don't care, unregulated, don't know enough about it. Whether they formed an opinion either way, I don't know. But there's just apathy. And then there's probably whatever remains there. And I think it's 15% remaining that are very anti, very much want to make their views known, accusing me of being a snake oil seller. And that's fine, right? That's I'm okay with that. Bitcoin is for everyone. No, Bitcoin is for anyone, but it's not for everyone, right? So some people are always going to be against it. Hopefully at some point, right, and based on where I believe Bitcoin is going, at some point they'll come around, because 5 years from now they'll start to lose clients to firms that have incorporated Bitcoin within their investment thesis today. And I believe there is a business here. I just need to stay in the game long enough that some firms start to lose clients to other firms who have incorporated Bitcoin. That could take 2 years, 3 years, 5 years, 10 years. So it's tough, right? I'm right at the coalface. I described it recently as I'm trying to hack my way into the thickest jungle imaginable with a blunt machete by myself. Right? So I'm trying to forge a path that has never been forged. So it's going to be tough, and I'm okay with that. Your second question, remind me the second question.
I think you covered them both in there. Can't remember.
It was how am I finding it? Oh, and the firms. It was the type of firms.
What types of businesses? That's it. Do they have a similar look?
Yes. So it's generally firms very similar to Capital, right? So 20 to 40 people, owner-led, and have curious and open-minded owners. So I've got quite a few bookings for the workshops, in person or online, coming up.
Yeah.
And when I think about it, the owners are either already Bitcoiners or they're just open-minded and curious, right? And it kind of makes sense when you think about it, because these are the guys who they're doing pretty well, but they can see the consolidation, they can see the sharks circling, they can see the large firms. And they've got to do something to stand out. They have to do something to differentiate themselves. And it's something that I push very heavily in the workshops and in my content on LinkedIn and Twitter and within the podcast, which is, this is a way to differentiate yourself. Because, to my knowledge, I don't know every firm in the UK, but to my knowledge, there's only about 2 or 3 that are actually starting to incorporate this now and are getting ahead. And, Alan being one of them, I believe. A couple of others, Chris, who was on recently on the podcast, said that, the second the ban is lifted, the only thing for them will be how to get those stochastic models, and then how quickly can they get their clients into Bitcoin. Like the quote he used was, "How do we do this as quickly as humanly possible?" So that's generally the sort of makeup of the firms that I'm seeing. I've had individual firm owners, so under the larger networks, reach out, right? But they're not necessarily willing to pay for the services yet, because there's no way that anyone under the SJP, M&G or Quilter umbrella, they can't get their clients into it anyway until obviously their investment teams in the back end start incorporating Bitcoin. So, but there is interest there. There's certainly interest. So, yeah, generally, smaller SMEs, founder led, and the founders are curious or already Bitcoiners.
I think we've spoken about, haven't we? Like, is there a risk to the longevity of client relationships if the advisors aren't talking, or engaging in this topic that's going to be of interest to a lot of their consumers? But what I'm also wondering is whether there's a risk of firms losing advisors, because I bet there are a lot of younger advisors in a lot of these businesses that have more of an interest than perhaps the owners, and might be, trying to encourage the business owners to, again, at least get curious about something like this. And yeah, you just wonder, don't you, if they'll start to think, well, hang on a second, I'm curious about this. There's a lot of noise about this. I feel like this is something we should be at least being trained on, or at least being informed about. I'm hearing about these other cool companies over here that are doing this sort of thing. A big risk to financial planning firms is losing advisors, because finding good advisors these days is such a challenge. So I do wonder if the there might be that risk to firms as well if they ignore this.
It's not something I considered, but now seems quite
No.
obvious. And I think there's also an emotional intelligence piece, right, that people need to be aware of, which is, if a client comes to you and is asking about Bitcoin or crypto, it's often not just about the money, right? It's about, they want to be informed, they want to be involved, emotionally involved in their own portfolio, and giving some input. Right? They just want to feel collaborative with the financial planner. And if the financial planner just shuts it down, it's not regulated, we don't offer it as a firm, whatever it is, without exploring the why, right? Without going into the what's piquing or driving your curiosity to want to talk about this asset, then that can often be taken by the client as just a complete shutting down of that client's values, emotional interest, etc., etc. So, and so yes, they may lose advisors, but I think what's more likely is they'll lose clients, and then the advisors will follow the clients to the firms that they go and work for, right? Especially if the advisors have an emotional connection to the client, but through the regulatory aspect of the internal regulatory aspect of the firm, they can't speak to clients about it, and they have to just shut down those conversations without being curious, without trying to push that back up the chain and say, look, I've now had 5 clients reach out to me about Bitcoin. I've had to shut them down in line with guidelines, but I really want to speak to them about it. I think we should explore this more. No. Well, then, yeah, you're going to lose the clients and you're going to lose the advisors. It's a really good point.
Interesting times.
On that, actually, let's explore that a bit more. So, in your role at MELO and with the firms that you talk to, how do you see something like Bitcoin progressing? Let's say the ban was lifted today. For some firms start incorporating Bitcoin, some don't. In fact, I mean, they can get exposure to Bitcoin today anyway within FCA guidelines. So let's say 20% of firms start incorporating Bitcoin, 80% continue not to. What do you see in terms of growth, and also in terms of when it comes to selling their firms, right? Do you think that makes them more attractive or less attractive? Less attractive?
Hey, team. Just a quick pause to say a huge thank you. You've given us your most precious assets, your time and your attention. And honestly, it means the world to us. If you've enjoyed this episode or you take value from these conversations, it would really mean a lot if you could like, comment, or subscribe. Those things really help the algorithm and they help the channel to grow. And if there's someone in your life who would take value from this, maybe a fellow advisor or someone just curious about Bitcoin, please send it their way. You never know what it might spark. Okay, back to the studio.
I think, look, where we are is we're always looking at risk within the businesses that we work with. We have a saying which is everybody exits, right? So whether we're working with firms who are, you know, at the point of exit, a year or two away, or 10 years out, whatever work we're doing with them, we've got the end in mind, because that's the reason you're a business owner, right? Because at some point you want to get out. And in this regulated space, buyers ultimately are looking at two things within a business. They're looking at opportunity and they're looking at risk. And in the current market, risk actually is more important than opportunity. So they'll essentially assess, a buyer will assess the risk profile of a business. If it ticks that box, then they move down and they look at the opportunity. And if that's there, then, great. Now, the reason I mention that is that it means that we're in a position as an organization where we also have to and want to tread very carefully around topics like this. But we need our firms to have an awareness and to start to educate themselves. So that would be my first kind of step with these businesses, is to start to say to them, we are not suggesting that you change your portfolios. That's not our role within businesses anyway, right? We'll help them to take a look at their proposition and things like that. We're not investment specialists, nor do we want to kind of advertise ourselves as being such, right? But actually, guys, you've now got to start to educate yourself on this really important topic for all of the reasons that we've discussed. And from there, they start to make their own decisions based on their own knowledge. And they start to make their own decisions in a way that still protects their business, because that has to be paramount, protecting the business. But one of the things I found really interesting when you and I were talking the other day was you've now started to get interest from compliance firms. The firms, most of these privately owned financial planning firms that we work with are of such a size that they have outsourced compliance. And so, of course, if you're paying an outsourced compliance firm, you want them to protect you, and you tend to, abide to an extent, with what they say and build your business on that basis. Well, now all of a sudden, if we're going to start to have compliance companies saying to these firms, this is a topic that you need to start to, at the very least, understand, and us and other consultants in this space who are not looking to help businesses build the firm of 2025, we're helping businesses to build the firm of 2030. So it's a balance, Dan, I'll be honest with you, because we want to future-proof these businesses, but we need to protect their risk profile. But it's the growing awareness through people like yourself and the fact that now compliance companies as well, who we work incredibly close with, are wanting firms to start to learn more about this. We'd treat it with kiddie gloves, but it's that knowledge piece is in my view fundamental to where firms need to be, and that's not impacting on client. We're not at the point yet where we're telling you to change anything or upend your client portfolios. We're not there yet. We're just trying to say to you, if you're not already learning about this, there are some amazing resources now that will give you access to sound information about this, such as yourself.
Well, thank you. And yeah, absolutely. That's, I make it very clear. I'm not here to shill or sell Bitcoin, right? I personally believe it would help your firm and your clients. But if that's not your belief after doing the research, that's absolutely fine.
Yeah.
this may come across wrong, but it makes no difference to me whether you buy Bitcoin or get Bitcoin exposure for your clients or not. I believe it would help, but whether you do it or not is up to you. What's important is that you know about this asset and come to your own conclusions. Carl Widger on episode 70 of the Trap podcast made it very clear he will not be buying Bitcoin exposure for himself or his clients.
Yep.
And he gave a very good reason not to, which is his clients will benefit from Bitcoin exposure when the great companies of the world adopt Bitcoin. And that's a really good argument. It's not something I thought of. It went straight into my workshops. And guess what? Shocker, I completely agree with that statement. You absolutely will. In fact, if you have any exposure to global equities, you probably have some exposure to North America, which means Coinbase were entered into the S&P 500 in May this year. MicroStrategy, now Strategy, have a 91% chance of being admitted into the S&P 500 this year. They are available for consideration as of the 1st of July this year. So Bitcoin had to remain above $95,000 throughout Q2, which it did for Strategy to be considered for the S&P. So they're more than likely to be added. You've probably got Tesla exposure. They have Bitcoin on the balance sheet.
Yeah.
You've probably got some exposure to Mercado Libre in South America, who are the South American equivalent of Amazon. They have Bitcoin on the balance sheet.
Yeah.
So you like it or not, you
it's
and your clients
already.
are going to have exposure to Bitcoin. You probably already do. The asymmetric opportunity is having some direct exposure rather than having it lost and diluted within a balance sheet. Other than Strategy. So if Strategy gets added to the S&P, then it's pretty. They do have a business, but it's like 0.01% of their revenue or their share price now, their market cap. So that might change things slightly. But the way I try and position it is, imagine you could go back to 2018 and put a 1 to 2% allocation of your client's portfolio into the underlying technology of AI.
Yeah.
Right? Because right now, all of the benefits that your clients are going to see from this new technology, from the ingenuity of human endeavor, which is AI, is lost within the balance sheets of Google, Meta, Microsoft, right? Those are the three major players. So even if AI causes those companies to go 5x, 10x, that's a relatively small impact on your clients' portfolios, right? It's huge for the companies. But the underlying technology, right? Imagine, again, we're in adoption at 3%. Imagine you could have put 1% of your portfolio into the internet in 1990, the underlying tech, not having to buy tech stocks that ended up acting like penny stocks and going through this huge bubble. If you could have just bought the internet and held it for 35 years, if you could have bought online banking and held it since 96, if you could have bought social media in 2005, as opposed to having to wait for the Facebook IPO in 2012, you'd have still done very well with the Facebook IPO. But if you'd have bought Facebook and YouTube and MySpace and Microsoft Messenger, Jesus, there's a throwback.
You're giving away your age, which sounds like it's about the same as mine.
So that's the way I like to position it. Like, you are going to get exposure whether you like it or not. You are going to benefit from it whether you like it or not. But there is probably an asymmetric opportunity from having direct exposure.
You mentioned the larger companies holding Bitcoin on the balance sheet. Have any firms spoken to you about holding Bitcoin on their own balance sheet?
Yes, they have. So I talk about this in the workshops as well. So it's one of the I go into what are the potential benefits for Bitcoin for you as advisors, as well as your clients. And one of them is that you can hold Bitcoin on your balance sheet, right? Which obviously helps to reduce income tax. It can, if you don't ever want to sell your business, or if you do come to sell your business, it's a large asset on the balance sheet. But it also provides for dividends, for example, in down years or throughout retirement, and it can help to offset any losses in future, right? So if you have a year with a loss and you've made a gain on Bitcoin, then you can obviously offset that loss. I've had at least, there's at least two that I know of that are very much considering it. And I always talk about a company called the Bitcoin Collective. There are others. I'm not pushing or selling them. I'm just aware that these guys are probably the market leader in the UK. I know Jordan, the founder, quite well, and these guys can advise and consult on the routes to market there and how to do that safely, securely, confidently.
That's interesting. I would say with my exit hat on, which I wear every day, that just for owners to be aware that when if an acquirer is going to come along one day and acquire the shares in your business, if you're running a limited company, they don't want anything on the balance sheet. So it's just being aware. There's nothing wrong with therefore holding it as you go along. But you've got to think about, and you've got to take the tax advice on how do we get this out. If we're going to be looking to sell in 5 years' time, at what point are we going to sort of take this off the balance sheet? So we see the same happening, for example, with like property. If a business owns the physical bricks and mortar, and it's actually owned in the business rather than like in the advisors, the owner's SIP or something like that, then there will more likely than not be an exercise where that property needs to be shifted from the balance sheet because acquirers don't want the bricks and mortar. Same if they're holding like an investment account on the balance sheet, that will be sold down and dealt with. So this isn't like to sort of put anybody off or anything like that, but it's thinking, again, my view, as I said a couple of times today, is always make sure you've got the end in mind. Because being ready to exit is meaning that you're running a good business at any given time. So it's saying, right, well, if this is something I want to do and I want to add this to my balance sheet, cool. What does that potentially mean if I do want to look to sell? Less of a challenge if they've got a holding company structure potentially.
What's the reason for that? Why do the holding companies not want to buy the assets?
It's the acquirers, like really they don't want all the other bits and pieces, like they're acquiring the shares of the business. Most of the time they don't want to buyers don't really want the shares of a regulated business, but they will acquire the shares of a firm if the risk profile of that business is right. And it's a competitive space as well, so but the reality is what they really want is they want sort of the trading assets that sit within the limited structure. They don't want that advisor or that owner's investment, but corporate investment. They don't want the property that they're trading from. So there's some work there to be done. But this is why, like, when you're looking to exit, you get ahead of the game, right? You don't just go, although still most do, like, hey, Vicky, I want to sell my business. It's like, hey, I'm thinking about selling my business in the next 2 years, 3 years. Okay, well, let's start to think then, let's start to build a strategy. And if there's anything that's sort of on the balance sheet, then it's just looking at a strategy for when those assets will be lifted off.
That makes sense. Okay. Well, there's another route to actually just holding pure Bitcoin rather than paper Bitcoin, which is through a SaaS. So if you are a limited company owner, rather than holding it on your own balance sheet, you can set up a SaaS and then you can actually buy on-chain Bitcoin. I'm not there yet. I'm in the process. I will be doing that in the next 6 months. The only reason I haven't really undertaken that yet is because if the 4-year cycle, the observable 4-year cycle, is to play out again, then we could expect a large drawdown in 2026. So realistically, that's the point at which I want to be deploying a SaaS and then buying on-chain Bitcoin, buying as much Bitcoin as I can within my SaaS, and then just sitting on that for 20 years.
Yeah, and that's where like your additional knowledge is really valuable. I could well be buying at the wrong times if I was to track sort of cycles and things, but it goes back to what I was saying at the start. I just have such a long-term view with this. It's not going to impact on me from a capacity for loss perspective, so I know I can take that long-term view. And if I'm not buying and selling along the way because I don't want to get it. I'd rather not get it wrong than have the potential of getting it right. I mean, I'd love to get it right, but you get what I'm saying. And I think, yeah, when people are just starting to learn about something like this, or just starting to dip their toe in something like this, my view is it is probably better Don't try and time it. We as advisors say, right, it's time in the markets, not, no, what it, that's the one. Yeah. Time in the markets, not timing the markets. So apply that to your own situation as well, is my view.
I completely agree. I make it very clear in my workshops, we are not traders, right? But you just need to be aware of the 4-year cycle. And the reason you need to be aware of it is because of managing client expectations, right?
Yes.
So if you're going to buy a lump sum, if you're going to put 1% of your client's portfolio into Bitcoin now, then you need to manage their expectations, which is we're in year 3. Historically, we have seen large drawdowns in year 4. If you have held Bitcoin for a minimum of 200 weeks, because it's a 4-year cycle, so 200 weeks, roughly 4 years, it has a 100% hit rate of returning more than you've invested. Right? So the 200-week moving average of Bitcoin just goes up and to the right, right?
Okay.
Day to day, it can be volatile. When you zoom out and think in decades, it goes up and to the right. The 200-week moving average has never declined.
Okay.
So I always say it's a minimum 4-year investment. FCA guidelines are a minimum 5. So it's perfect, right? It aligns very well. So absolutely, I completely agree. Also, if you're DCAing, which it sounds like you are, right? So you're just buying at regular intervals, there is never a wrong time to buy.
What's DCAing?
So DCA is dollar cost average.
Okay.
So it's the strategy by which we buy our pensions, right? We pay in an amount from our income every month, and then we just convert it to units within a fund every month. That, when you look at that over a 40-year period, that's a pound cost average, dollar cost average.
Yeah. Pound cost average in our world.
Yeah, exactly. So a PCA strategy. So if you are PCAing into Bitcoin, I don't think there is a wrong time. And as Michael Saylor says, he'll be buying the tops forever. So there isn't a wrong time if you're PCAing. There isn't a wrong time if you're holding for a minimum period of 5 years, right? Because it has a 100% hit rate of returning more than you've invested, even at the tops. You could have bought the absolute top in 2021, which was $69,000, and as of today, which is just under 4 years later, the absolute top I think was October, November 2021. So just shy of 4 years, and we're almost 2x today. So but having played this game and doing a bit of trading myself, and because my goal by the time I retire is to have as much Bitcoin as possible, then I'm prepared to take the risk that we see a drawdown in 2026. We may not. It may go up only forever from here, right? As another very famous Michael Saylor quote is, "It's going up forever, Laura," right? So it may do, and I may miss out, and I may end up getting less Bitcoin in my SAS as a consequence. And I'm prepared to take that risk because by the time I retire, I want life-changing, intergenerational wealth rather than just looking after my pension or my own retirement. But personal thing, I'm all in. I do not recommend anyone else goes all in. It's it's a wild ride, and there is, in my opinion, still a very small risk. It's not a 0 probability that this thing could fail.
Yeah.
But it's very small.
And it will probably be our next generation that will really benefit from what we're doing now. So I also do look at it a little bit as an inheritance tax, not inheritance tax, sorry, an inheritance kind of tool, like such is the kind of the length of exposure to this that I'm comfortable with, which again comes back to the capacity for loss point, like make sure you're okay, make sure you can feed and water your children, like number one, and then, right. And what else am I building then on top of that? So I can give myself the ability to, exit work and have sustainable income. That's what we're all looking for. It's that I want to be okay. Right. Cool. And then it's what can you do over and above that. So yeah, I sometimes think, I wonder if I will ever spend my Bitcoin, or if actually it is just going to be something like a piece of art almost, like that I'll just pass on.
it's getting easier and easier to borrow against your Bitcoin, and obviously you pay no tax on debt. So there are companies springing up. I'm wary of them. That, like any industry, there will be winners and consolidation, and there will be losers. So for now, I'm just interested to see how they play out. Also, in the UK, we make it very difficult to do that because in order to borrow against the Bitcoin, you have to custodian the Bitcoin with them. And whenever you move your Bitcoin in the UK, that creates a sellable event. So then, just to send it there, you probably have quite a large capital gains tax, which is probably then not worth taking out the loan because, to save on the income tax. But I believe that will change long term, but we shall see. Vicky, I'm wary of time.
Yes.
We could talk. We're going to have to do this again because I think we could talk about this for hours.
Talking to you. I like learning. This is the thing. I'm just a big learner, and it's like, do you know what? I'm going to do something this morning. I don't know anything like as much as our Dan knows, or as I now affectionately call you, Biffa, as you in my phone. But I've got a curious brain, and I'm here for learning, and it's been a really enjoyable bit of time that I've spent with you today, and I've made a load of notes, and yeah, you've given me some reading for the weekend as well, so cheers for that.
And you're coming on the workshop in a few weeks as well.
So, I am. I'm going to get
through the whole thing.
Yeah, I'm going to get to see what the advisors see, so I'm going to get to sit in their seat as an attendee, which I'm really looking forward to. So
me too. There's the last question that we always ask everyone, which is, what is one positive thing that Bitcoin has brought to your life outside of number go up?
More of an awareness of the understanding of money. It's all around us, right? It's something that we just use in daily life, but it is that awareness of like, well, where did this all come from and how has this changed over time? But beyond money, it's been the learning about inflation, because inflation has been something that's always there, right? There's like this government target, but what does it really mean and why is it really there? And actually, that's been a really interesting learning, is understanding the inflationary issues, and how this can combat that. So, yeah, the learnings. It's all in the learnings, sir.
I think you've given people stuff to go and research themselves there, and we could talk about that for ages. But for now, we'll have to do a part 2. Yeah. Vicky, thank you.
All right, thank you.
Have a great day.
You too, mate. Thank you very much.